The dollar is under pressure, and gold and silver are acting like the market just saw something it can unsee. Because once this kind of bid shows up globally, price discovery stops being a polite debate and starts being a tug-of-war. And the conflict is already visible. One side is trying to frame this move as just emotion, just headlines, just speculative heat, while the other side is buying like the cost of waiting just went up. The hidden mechanism most people are missing is that a chunk of the selling you might have seen recently wasn't investors changing their mind at all. It was mechanical forced flow hitting the market on a calendar. And the metals didn't break anyway. That detail matters because if price can absorb forced selling and refuse to collapse, you don't have a fad. You have a pressure system building. And by the end of this, you'll have a clean near-term checklist for what matters over the next week or two, what levels and signals actually confirm the thesis, and what would invalidate it fast. So you're not guessing while volatility tries to shake you out. Right now, the mainstream story wants you to believe this is a spike that will fade the moment the news cycle changes, because that story is comfortable. It keeps institutions looking in control. It makes it sound like the dollar is fine, liquidity is fine, everything's fine. But markets don't move like that when the plumbing is stressed. They move like that when the cost of hedging rises, when the risk-free rate isn't really risk-free in the way people assumed, and when the world quietly decides it wants a different mix of reserves, collateral, and protection. And that's where the real pressure starts. Let's ground this without pretending we can see every ledger in the world. Over the last stretch, gold and silver have been trading with that unmistakable fast tape feel, sharp pushes, violent intraday reversals, thin liquidity pockets where price jumps like it hit an air pocket, then snaps back. That's not the signature of a sleepy, well-balanced market. That's the signature of a market where positioning is being forced to move, where dealers are scrambling to stay hedged, and where physical demand doesn't politely wait for the paper market to calm down. And the first thing you have to understand is that gold and silver aren't just assets. They're markets with two overlapping realities. The paper reality that trades fast, levered, and huge, and the physical reality that trades slower, has friction, and eventually decides what the paper can get away with. Most people watch the headline price and think that's the whole movie. It isn't. The movie is the spreads, the premiums, the delivery incentives, the financing terms, the hedging flows, and the way risk managers react when volatility spikes. And if you want to understand why investors worldwide are rushing into gold and silver while the dollar looks shaky, you have to watch what market structure is forcing participants to do, not what commentators are saying they feel. Here is the big picture in plain language. Gold and silver tend to catch a bid when the market senses that the unit of account, the dollar, has a higher probability of losing purchasing power relative to real stuff, or when the financial system's promise of instant liquidity at fair prices looks less guaranteed than people thought. That doesn't mean the dollar is ending tomorrow. It means the distribution of outcomes is widening, and when outcomes widen, demand for insurance rises. Gold is the classic insurance. Silver is the messy insurance that also doubles as an industrial input, which is why it can overshoot and whip around like it is trying to throw people off the deck. But that's not the part that matters. The part that matters is how the demand shows up. When demand is mostly retail impulse, you get a quick pop and then a fade as attention moves on. When demand is institutional rebalancing, sovereign reserve behavior, corporate procurement hedging, and I don't trust this regime allocation, the bids show up on down days, the dips don't behave like they used to, and the market starts absorbing supply that would normally knock it down. And that absorption is a signal. Now let's talk about the hidden detail, because it reframes everything. In commodity markets, a lot of money isn't making a story call. It's following rules. Large commodity indices and systematic strategies rebalance at set times. They adjust weights, roll contracts, and sometimes reduce exposure to something that's run too far relative to their target. That creates forced flows, selling into strength or buying into weakness, regardless of what people think about the macro narrative. And in the metals complex, those flows can be enormous over a short window because the futures markets are liquid enough to take the hit. So when you see a sudden burst of selling pressure that seems out of sync with the story, like a hard shove down that doesn't have a clean headline attached, there's a real chance it's calendar mechanics, not smart money bailing. The underappreciated point is what happens next. If that forced selling hits, and instead of cascading into a multi-day collapse, the market stabilizes, rebounds, or even grinds higher, it means real demand is waiting underneath. It means the market isn't fragile in the way people want to believe. And that is exactly the kind of behavior you see at the start of regime shifts. Sellers throw what they have, and the market shrugs and says, "Is that all?" But don't take my word for it. Look at how volatility behaves around big levels. Big levels are not magic because humans draw lines. They're magnetic because options exist, and options force hedging. This is where the move stops being emotion and starts being math. Dealers who sell options don't just sit there and hope. They hedge. When price approaches major strikes, those round numbers and popular levels, dealers' hedging flows can amplify the move. In simple terms, if price rises and dealers are short calls, they often have to buy the underlying or futures to stay neutral. The buying can push price up more, which forces more buying, which pushes price up more. Reflexivity. Not a conspiracy, just mechanical risk management. And the flip side is brutal. If price breaks down through a level where positioning is crowded long, the same mechanics can force selling, cascades, and sudden air pockets. Silver is especially prone to this because it's smaller, more volatile, and more sensitive to margin pressure. Which leads to the next pressure point, margin. Silver markets don't just move on opinions. They move on what exchanges and brokers demand as collateral. When volatility rises, margin requirements rise. When margin requirements rise, leveraged players have to post more cash or cut exposure. And when they cut exposure, it can look like everyone suddenly changed their mind. And they didn't. They got a margin call. They got a risk memo. They got a VAR model screaming that their position is now too expensive to carry. And forced selling can happen even if the long-term thesis is still intact. This is why credible metals analysis has to include a warning. Price can whip around violently even if the thesis is correct. If you're right about direction but wrong about leverage and timing, the market can still take your position away from you. And that inks eyes where a lot of retail investors get emotionally manipulated because volatility is the weapon the market uses to transfer exposure from weak hands to strong hands. The market doesn't need to convince you with logic. It just needs to make you feel stupid, late, and scared, all in the span of a few candles. But here's the difference between noise and signal. Noise is the intraday whip. Signal is what happens to dips. Signal is whether breakouts hold on retests, whether spreads stay tight or stressed, and whether physical demand keeps paying up. And that's the next detail that flips the whole setup. Physical versus paper. The paper market, futures, options, OTC derivatives, sets the headline price because it's fast and huge. But physical demand reveals itself through premiums, availability, delivery incentives, and sometimes through weird dislocations between regions. In a calm market, you don't pay much extra to get metal now versus later. In a stressed market, people pay up for immediacy. And you'll often see it first, not in the spot price, but in the term structure, the curve. When the front end of the curve tightens, when nearby contracts trade stronger relative to deferred months, that's the market saying, I need it now. That can show up as backwardation or as unusually strong nearby spreads, depending on the metal and the financing environment. You don't need a PhD to interpret it. The message is simple. Urgency costs money, and the curve is where urgency leaves fingerprints. If urgency is rising globally while the dollar is under pressure, it tells you the bid isn't just US retail chatter. It's multi-channel demand. And that's why the title says worldwide, not on your timeline. Now, step back and ask, why now? Why this week, this month, this moment? There are always reasons you can invent after the fact, but the real market triggers tend to be calendar-driven. Options expiry, futures expiry, delivery windows, month-end rebalancing, quarter-end risk management, thin liquidity around weekends and holidays, policy meetings, and CPI prints that change rate expectations. These aren't just dates on a calendar, they're deadlines for positioning. Funds have to show a book, dealers have to neutralize gamma, systematic strategies have to rebalance, and when the market is already tight, these deadlines can turn into catalysts. That CEU is the calendar catalyst, a forced flow window colliding with a market that already has underlying demand. One side is forced to sell because the rules say so. The other side is willing to buy because the regime says so. And the tape becomes a negotiation in real time. If you've ever wondered why metals can rip on days with no big news, that's your answer. Markets don't need a headline when the machinery is moving. And that's not the part that matters. The part that matters is what these flows do to price discovery. In a stressed setup, paper selling can push price down briefly, but it can also flush weak longs, reduce open interest, and hand inventory to stronger holders who don't care about a 3% drawdown. Then, when the forced selling ends and liquidity normalizes, price can rebound faster than anyone expects, because the supply that would normally show up on rallies is gone. That's how you get that eerie, the dip didn't last feeling. It's not magic. It's the market transferring metal exposure to hands that won't sell easily. So what's driving the worldwide rush into gold and silver at the macro level? Start with the simplest driver, currency stress. The dollar doesn't have to crash for metals to rise. It just has to lose momentum or simply stop tightening financial conditions the way the market expected. When rate cut expectations increase, when real yields look less supportive, when deficits and issuance dominate headlines, when geopolitical risk widens the tail outcomes, metals get treated as a hedge against policy uncertainty and purchasing power erosion. At a second layer, reserve behavior, and diversification. You don't need to claim a dramatic dumping of dollars narrative to see that a world with more geopolitical fragmentation has more incentive to diversify reserves, settle trade in multiple currencies, and hold collateral that doesn't depend on another country's banking system. Gold is the cleanest expression of that instinct. Silver is a messier expression, but it benefits because investors often reach for the cheaper metal when gold feels expensive, and because silver has industrial demand that can tighten supply in unexpected ways. That's the third layer, supply chain reality. Mining is slow. New projects take years. Silver is often a byproduct of mining for other metals, which means supply doesn't ramp just because silver price is high. Refining capacity matters. Logistics matter. Recycling helps, but it doesn't instantly appear in the quantities the market wants at the moment it wants them. So when demand surges, the physical market can't respond like a tech company spinning up servers. It responds like a real-world supply chain with delays, bottlenecks, and price signals that show up in premiums and spreads. Now, stack the proof like a pro, because one argument is never enough. Proof point one is behavior, the speed and persistence of the bid, where dips are bought faster than people expect. Proof point two is market structure, volatility and margin dynamics that imply positioning is being forced around, not gently reallocated. Proof point three is the curve and spreads. When nearby pricing is strong relative to the back end, it implies urgency and tightness that can't be explained by a single headline. Proof point four is global comparison. Different regions show different demand intensity, and when certain hubs pay up while others cool, it tells you the marginal buyer is concentrated, not imaginary. Proof point five is institutional flow logic. ETFs and large allocators tend to express gold exposure through liquid vehicles and futures. When those flows align with physical tightness, price is less likely to mean revert quickly. Proof point six is the hidden detail itself. Forced selling windows that fail to break the market are historically more consistent with continuation than with collapse because the market already had to absorb a shock and proved it could. Proof point seven is the cross-asset context. When equities wobble, credit spreads twitch, and the dollar loses its bid, metals often act as a liquid hedge. And that's exactly when you see rushing behavior, because investors are not chasing upside. They're buying protection. And that's where the real pressure starts. But let's not turn this into a one-way hype machine, because that's how you lose trust. Metals can absolutely pull back hard. They can trap late buyers. They can do the cruel thing where the macro thesis is right and your entry is still wrong. The clean counterpoints are real. One counterpoint is a sudden dollar rebound. If the market reprices, rate cuts out, if real yields jump, if risk-on sentiment returns aggressively, the dollar can catch a bid and metals can get hit. Another counterpoint is that physical premiums can cool if local demand gets priced out, or if policy changes alter import behavior. Another counterpoint is positioning exhaustion. When everyone who wants exposure already has it, rallies can stall and you can get a sharp mean reversion. Another counterpoint is liquidity events. If there's a broad deleveraging, metals can be sold because they're liquid, even if they're safe. That's a key lesson. Safe assets can get sold in a margin event because cash is the only thing that settles everything. So you need a framework that keeps you from marrying one story. You need a two-scenario lens. Scenario one is the controlled pullback and retest. In this scenario, gold and silver pull back in a way that feels scary in the moment, but is structurally healthy. Volatility spikes, headlines turn bearish, social media screams top, and then price stabilizes above the prior breakout shelf. It might take days, it might take a week or two. The key is that the market shows absorption on dips. Downside candles get bought, spreads don't completely normalize, and the bounce isn't just a dead cat. It regains key levels. This scenario is the market digesting gains, shaking out leverage, and then continuing higher once the weak positioning is cleared. Scenario two is the continuation squeeze. In this scenario, price doesn't give you the polite retest. It grinds higher, accelerates through round number strikes, and you see those reflexive options hedging flows kick in. Dealers buy into rising price. Shorts cover because the pain becomes intolerable and the move feeds on itself. This is where you get gap risk, where weekends matter, where thin liquidity turns into sudden price jumps, and where people who waited for the pullback never get the entry they wanted. Both scenarios are plausible right now because both are consistent with a market under stress. The difference is the confirms. In the controlled retest scenario, you want to see pullbacks contained within normal volatility for each metal. Think a few percent for gold, and a bigger, uglier band for silver, because silver is built for whiplash. You want to see a stabilization period rather than a straight line collapse. You want to see the market defend a prior consolidation zone. In the continuation squeeze scenario, you want to see price reclaim highs quickly after shallow dips, and you want to see evidence that the market is still paying up for immediacy, through strong nearby spreads, sticky premiums, and persistent demand for hedges. And that's not the part that matters. The part that matters is what you watch over the next week or two, so you don't get hypnotized by single candles. If the dollar gets good news and can't rally, that's a tell. If the dollar gets bad news and accelerates down, that's fuel. Second, watch real yields and rate expectations in the market's pricing. You don't need to predict a meeting. You need to watch whether the market is leaning toward easier conditions. Third, watch the metal's reaction to forced selling days. If you see a sharp sell-off that looks mechanical, fast, heavy, and then abruptly exhausted, pay attention to what happens next. If the market stabilizes quickly, that's strength. Fourth, watch the curve and spreads, especially the relationship between nearby and deferred pricing. If the front stays firm, urgency is still there. Fifth, watch physical signals, retail availability, coin and bar premiums, and regional demand anecdotes that align with the tape. If physical tightness persists while paper volatility spikes, that often supports the bigger trend. Sixth, watch options-related magnets. When price approaches big round numbers, does it stall and reverse, or does it slice through and keep going? That behavior can tell you whether dealers are dampening the move or forced to chase it. Seventh, watch volume and open interest behavior. Does the market rally on rising participation, or is it a thin squeeze that could snap back? You don't need perfect data, you need directional clues. Now let's talk about invalidation, because credibility lives here. The thesis that investors are rushing into gold and silver because the dollar is under pressure gets weaker if the dollar stages a sustained rebound alongside rising real yields and tightening financial conditions in metals fail to hold their prior breakout zones on a weekly basis. It gets weaker if physical premiums and immediacy signals cool meaningfully while the paper market continues to churn, implying the physical bid was temporary. It gets weaker if the curve normalizes and the market stops paying up for nearby delivery. It gets weaker if you see a pattern of rallies that are instantly sold and cannot regain prior highs, suggesting distribution rather than accumulation. And it gets weaker if macro conditions shift in a way that reduces tail risk, if volatility across markets compresses and the need for insurance bid fades. You don't need to predict these outcomes. You just need to know what would make you update your view. That's how you avoid being emotionally manipulated by volatility. And make no mistake, volatility will try. It will hit you with a sharp drop right after you feel smart for being bullish. It will rally without you right after you sell in frustration. It will make you think you're late, then punish you for chasing. This is the market's oldest trick. Turn uncertainty into urgency, then turn urgency into regret. Your defense is simple. Separate the time horizon from the noise. Decide whether you're watching this as a macro signal, a medium-term trend, or a short-term trade. If it's a macro signal, you care more about weekly structure, the behavior of dips, and the persistence of physical tightness. If it's a short-term trade, you care about volatility regimes, options magnets, and calendar catalysts like expiry and rebalancing windows. And if you don't have a plan for what you're willing to sit through, the market will plan it for you, using your emotions as the leverage. But that's not the part that matters. The part that matters is understanding what the rush into metals really is. It's not a single crowd. It's multiple crowds acting for different reasons at the same time. You have macro allocators buying insurance because the distribution of outcomes widened. You have institutions rebalancing because portfolios got out of whack. You have systematic strategies following rules. You have central banks and sovereign behavior that can be slow but steady. You have industrial users in silver trying to lock in costs or secure supply. And you have retail buyers who done to trust the official story and would rather hold something tangible. When all of those align even partially, the market behaves differently. It becomes less sensitive to one bearish headline. It becomes more sensitive to liquidity and positioning. It becomes a market where the spread tells the truth before the price does. And that was why the dollar being under pressure is not just a headline, it's the backdrop that makes this alignment plausible. When the dollar is strong in tightening conditions, the opportunity cost of holding metals feels higher and risk assets suck in the oxygen. When the dollar loses momentum, when policy uncertainty rises, when markets start sniffing easier conditions or bigger tail risks, the oxygen shifts. You start seeing real assets become the place people want to hide, hedge, or simply opt out. Now, let's put a finer point on what to watch next week, because that's where people either gain an edge or get whipsawed. If we get a controlled pullback, watch for a retest of the last consolidation area, where price based for a while before the breakout. That zone is the market's memory. If price revisits it and holds, it's telling you buyers are defending. If price slices through it and keeps bleeding without meaningful bids, that's a warning. In gold, controlled pullbacks often look tidy until they aren't. In silver, controlled pullbacks can still look violent, so you need wider tolerance and clearer invalidation rules. If we get the continuation squeeze, watch for acceleration through round numbers and an unwillingness to give back gains. Watch for tightness in nearby spreads. Watch for those no news rips, because they're often mechanical. And watch the weekend gap risk, because when positioning is stressed, the market OS favorite move is to reprice when liquidity is thinnest and stops can T execute cleanly. That S when people wake up to a different chart than the one they went to bed with. If you're prepared for that possibility, you don't get emotionally hijacked by it. If you're not prepared, you'll make decisions at the worst possible time. Now here's the subtle part that separates the serious from the reactive. You don't need to be bullish every day to respect the trend. You can think the macro setup favors metals and still expect brutal shakeouts. You can expect a squeeze and still accept that it might come after a gut check pullback. You can acknowledge that institutional flows and supply chain friction matter without pretending you can time every pivot. The goal isn't to predict every tick. The goal is to read the pressure system. And right now, the pressure system says this: the dollar is not providing the same easy comfort. It did in prior regimes. The world is behaving like it wants more optionality, and gold and silver are responding as insurance that's suddenly priced higher. The people trying to dismiss it as a fad are ignoring the mechanisms: calendar flows, hedging reflexivity, physical versus paper tension, and the way tightness leaks into spreads and premiums. That doesn't guarantee a straight line up. It guarantees a market that's awake, a market that's willing to punish sloppy positioning, and a market that's forcing everyone to pay attention. So here's the checklist, in plain language, to carry into the next 1 to 2 weeks. Watch the dollar's reaction function, not just its level. Watch real rate expectations for confirmation. Watch whether dips get bought quickly after mechanical-looking sell-offs. Watch nearby spreads for signs of urgency. Watch physical availability and premiums for signs the bid is real. Watch options. Magnets at round numbers for dealer-driven acceleration or suppression. And watch whether the market can hold its prior breakout shelf on a weekly basis. If those stay supportive, the rush into metals story remains alive and dangerous in a good way. If they break down, you respect it and step back, because the market will punish certainty more than ignorance. And if you're the kind of investor who demands mechanisms, not slogans, if you want the tells, not the hype, then you're already playing a different game than most of the crowd. Stay in that lane, track the signals. Don't let volatility rent space in your head. And if you want, use the comments like a trading desk whiteboard. Tell me what you're seeing in spreads, premiums, and the way price behaves around the big levels on your chart. Because the fastest way to stay sane in a loud market is to compare notes with people who care about the plumbing, not the propaganda.